So now that we've learned a little bit about the stock market, we need to take a look at just really what happened throughout the 1920s leading into the end of the 1920s. The stock market would play a major role in at least the start of the Great Depression leading into the 1930s. So remember, as a review, at the end of the 1920s, we still had things, great times, everything was going well. The United States enjoyed, remember, we said extra time to and extra money to really invest that time and money into themselves and enjoy entertainment and to get some items such as cars that in the past they couldn't afford. So it was an amazing time to live for many of these people, Americans. They could buy things, homes, cars. It was a great time. However, with all the factories, they were making so many goods and so many things that they actually overproduced. And in the end, there was not enough buyers for the products. The factories had to start laying off workers in the late 1920s, meaning they overproduced, they couldn't sell everything they had, and so many people no longer had jobs when factories either started to shrink or even shut down. And so that was one of the factors that was a sign that people should have looked at to see, okay, there's some things going on with our economy that are not good. And so people started to lose their job. Remember, like we talked about the other day, a stock is when people own a share or part, a tiny part of a company. Okay, so you can buy part of Chick-fil-A, of Coca-Cola. The stock value, if it goes up, you're making money. That price, the value of it goes up, all of a sudden you've made money. And what was happening in the 1920s is the majority of stocks were growing and making money. And this was an amazing opportunity for many people to say, listen, I need to get in on this and I need to make some money. And so lots and lots of people started investing in the stock market. Unfortunately, the stock market completely crashed. October 29, 1929 is a famous day. Stock market prices just suddenly fell. Stock market crashed and many people lost all their money when this happened. So all of a sudden, people that were monitoring the stock market, they saw, okay, things are starting to lose value very quickly. We need to sell our stock. And more people tried to frantically sell their stock until the value just plummeted more and more till they didn't even have value because everybody was trying to sell theirs. And so Black Tuesday, October 29, 1929, is an important day in history in America. It's known as Black Tuesday. Stocks are no longer valuable. The stock market fell. Billions of dollars were lost. People had panicked. They realized, like we said, that these stocks that they had, they needed to get rid of and try to sell, but no longer could they sell them. They were essentially worthless because the companies had plummeted in value because of all the people that tried to get rid of the stocks and to sell them for anything that they could get. The value of those stocks were minimal to even nothing overnight. And the problem with a lot of the system that was happening was people were making so much money on stocks that they had to get as much stocks as possible. So they would go to a bank and take out money. The bank would give loans. And the problem is banks would give out loans to nearly anybody. They were giving out money or lending money. You had to pay it back. They were lending money out to nearly anybody, regardless of whether they felt like they could pay it back and based on their job situation. So when the crash happened, the stock market crash happened, people owed lots and lots of money to the banks from these loans. People had said, okay, I'm going to borrow money from the bank, but I'm going to make a profit and I'll be able to pay the bank back and still have lots and lots of money. But when their stock values went down, they didn't have the money to pay back the loan. In fact, some people didn't have money even to continue having a home. So with all the people that couldn't pay back the banks, banks began to close. The problem with the banks was many of them had taken the money that people had put in the banks, and those banks started to invest money in the stock market also. Okay, remember, they have your money, and even today they do slight investments, but back then the banks dumped all their money into the stock market and they were making huge profits. But unfortunately, when the stock market dropped and plummeted, those banks didn't have that money. They couldn't get money back from the people, and so they had to close. Once banks started to close, people got word of that, and so they would rush to the bank to take out all their money. They wanted their money before the banks closed, and the banks didn't have money. This created chaos. People were demanding their money, and they would go to the bank and storm the bank and try to get in and say, we want our money back. That's people who had put money in savings and in a checking account, and so that money wasn't there for people to get back. So the result of all of this made the economy terrible. People could not spend anymore. And because they were buying fewer things, the factories had to close, because when people buy fewer things, the factories make less money, in which case when they're not making money, they have to get rid of workers. When the workers don't have money because they don't have a job anymore, then they can't buy things and the prices go down and the factories have to lay off workers. It's just a cycle, and it keeps happening where more and more people lost their job. More and more factories started to close. By 1932, factories were making half of the goods that they had in 1929. That's how terrible things had gotten. So there's some resources for you to explore. We're going to continue to talk about the results of this stock market crash, and really in the early 1930s leading to mid 1930s, what the conditions were and how terrible they were in America for many, many people.